In this video, I want to look at how do fund managers mine for wealth creating stocks. It's something which I'm often asked. What's the nitty gritty, the inside of what a fund actually does? Let me explain from the perspective of a long only, buy and hold, 12-month investment perspective. We're not talking about trading here, we're talking about the investing side. This is a process which we use. For instance, we tend to look at value stocks, growth stocks, and income stocks, the intersection of all three. Some nowadays call this factor investing or smart beta. It's really taken off in recent years. We've been doing this for over 12 years. Okay, and what I realized when I used to write a column for the Financial Times called The Diary of an Internet Trader, I used to do a lot of research for that weekly column. As you can imagine, a newspaper with millions of readers around the world, smartest people in finance, you don't want to get it wrong. And some of the research that I'd look into was the research out of universities. And this research looked into, mainly American universities, looked into the data from stock markets, particularly American stock markets, on what makes stock prices move. Okay, unsurprisingly, a lot of people had done this research. A lot of universities had been sponsored to do this. But what was surprising was the findings. When I collected all of this data and this research for my newspaper columns, for my books thereafter, what I discovered is that there was no particular reason to have, say, just a growth fund or just an income fund or just a large cap fund or a mid cap fund. That was just a marketing gimmick used by fund managers to lure in your money. There was no reason to restrict to any of those traditional methods. So I thought, well, why can't you have the best of all worlds, a value stock fund and an income and growth all in one? But if you were going to do that, what I realized is you needed to work out, well, what criteria should you look at? How do you determine if a stock is undervalued or is producing good income and therefore will rise in price or at least not fall? And how do you determine if something is a growth stock and therefore rise in price or at least not fall? So what were the key criteria you should look at and how important were each one? So for instance, I might look at dividend yield. In other words, how much income each stock in, say, Amazon or Vodafone is paying me. But what's the weight of that? If that is a relevant factor to look at, it's not the only factor. Therefore, if there's other factors, how much weight do I put upon each of these? And of course, one other thing that you had to do is you had to make sure that there weren't transaction costs. You weren't looking to do this every single day, and you needed to decide how much money to put into each stock. Should you put more into some and less into others? And what we found from our research is that there were certain valuation criteria based around earnings and revenues which were highly relevant. There were certain numbers, for instance, price earnings growth. Should we look at the relative values between different stocks and compare them, or should there be an absolute number? And what I found was that if you were willing to hold stocks for 12 months, now you might say, why not 1 month, why not 16? But these criteria, these fundamental criteria, when we're data mining stocks and their accounts, and our attitude was very much that we wanted to look at their accounts. We didn't really care about what their future plans were, because future plans always change and so on. We wanted to look at how had they been doing? What had they actually delivered? And let's assume for the moment that their accounts were honest and true and genuine and not fraudulent. After all, they're listed companies and they're regulated. Okay. Then we were able to mine all of this data and work out that on a valuation basis, an income basis, a growth basis, such as revenue growth year on year, that these were companies which were relatively undervalued. But of course, we all know undervalued companies can stay undervalued for a long time. But because they were also growth companies, they were growing year on year, they were likely to move up. And because they were generating dividends, they weren't likely to fall too far and become too cheap. Otherwise, big funds would buy into them in order to get that high dividend yield, that high return per share that they're getting in terms of dividends. But by holding for 12 months, we didn't have high transaction costs. We also knew that a portfolio of 14 stocks would be the optimal number. So something a private investor could also copy. Why 14? Why not one? Well, if you only held one stock, all your eggs would be in one basket. Why not 100 stocks like your typical fund? Well, if you have 100 stocks, imagine you're great and you pick one company which is going to double in value. Well, it's only going to be one stock out of 100 in your portfolio. So what's the point of having 100? 14 we found was the optimal point on a curve where by adding another stock, we weren't reducing our returns, even though by adding extra stocks, we're trying to reduce the risk we're taking. So we weren't putting all our eggs in one basket, but it's important to know how many baskets we should own and how many eggs we should have. The other rule that we put in to keep things really simple was that if any position dropped 25%, we'd have a hard stop loss and we'd be out of there. That way, if you think about it, you've got 14 stocks and let's say no one stock, and you put your money in equally in each one of them, no one stock can drop more than 25% because you get out, then the actual risk impact on your entire portfolio is about 1.8% of any one stock. 1.8% impact of any one stock onto your overall portfolio is actually very similar to what a major, say a $200 million or $200 million fund might also do. They'll have maximum exposure to any one trade of about 1.8% before they exit that trade. So what kind of analysis do we do? That's the analysis we did. We'd input all those stocks, and these are the kinds of ways in which we'd look at it. Once we weighed the relevant factors like price earnings ratio, price earnings growth, and we then scored everything out of 10. Why scored it out of 10? Well, you might say, why not? We wanted to keep things simple. We called it a value growth rating. The closer it was to 10, the better the stock name. And that's something which we did for the US and the UK market. And it's actually worked incredibly well. What it's done is outperformed every fund manager in the UK who invests in UK companies since we started doing this back in 2004. Simple piece of computing which does the data analysis and the data mining, and doubtless what fund managers do, except they charge a hell of a lot more. So my point is, the principles are that you as a private investor can be your own fund manager. You're better off being it because at least you're keeping 100% of the fees. And unlike a fund manager, you don't have to buy a whole load of rubbish stocks in order to earn those fees and churn your portfolio because you've marketed so well that you've got so much capital as a fund manager that you've got to now spray and pray and put it into any old rubbish. As a private investor, you can invest in companies which a big fund just can't because they're too big. And that's also part of our analysis and how we got to this success. So I hope you found that useful, that little video. Many more videos by me giving you insights into trading and investing success. But that video on how to mine for wealth creating stocks is that's all for now. Register on my YouTube channel. Follow me on Twitter as well.